Right, well, that seems like a good time to start. Thank you, everybody, for joining us. Welcome to Trending Treasury, which is our weekly webcast from Arlene Close that covers everything in local authority treasury, from debt to investments to accountancy to everything in between. This week, really to celebrate, commemorate, remember the fact that it's a year since we started lockdown. This week, we've got our first ever Trending Treasury guest back, which is Paul and John from CCLA. CCLA is run the local authority commercial property fund, which is a very, very long running fund with a long history and that has a significant number of investors in it. Paul's gave us a very interesting view a year ago, and we thought it'd be a great time to bring us back, bring him back in and interrogate him on all the things that he said was going to happen that did happen, and interrogate him on all the things that he said that would happen that didn't, and then and see where we think we are now and where we think the outlook is going. So Paul and John, how are you both? Paul, how are you getting on? Have you been vaccinated yet? Oh, you're muted, Paul, just to let you know.
Is that better?
That's better, perfect.
Yeah, no, yes, I have been vaccinated, and yeah, probably gives the game away as to my age, but probably the more interesting point is which vaccination have you had? So that's where the debate is, I think, and I think there's a bit of a snobbery around that. I think Waitrose shoppers will boast about having the Pfizer jab, whilst people like me shop at Aldi have had the AstraZeneca.
Well, I think all my family members who have been vaccinated up to now have actually had a mixture. So I've got my mum's had. I'm yet to be vaccinated, unfortunately, because of my extreme youth, and my mum had AstraZeneca and my dad had Pfizer. So we're gonna see, because obviously they spend all their time together now. So I suppose if one of them I'll be able to run my own little experiment on them. John, have you been lucky enough to get to be vaccinated? Oh, sorry, you're muted as well, John.
The sound was live a moment ago. No, despite my use, I've in fact been summoned in for a vaccination. I think as a national treasure, they didn't want me to take unnecessary risk, and they gave me a choice, obviously, of vaccinations. I went for the Harrods version, but others were available.
Great. Well, I'm glad to hear I'm glad to hear that the good news on the vaccinations applies to you both as well. So I suppose the best place to start would be where we left off in our last discussion. 12 months ago, well, it was 11 months ago, but this time last year we were looking at a pretty stark situation for commercial property in the UK, and obviously, as well managed as any fund is, you were not going to be immune to that. And I think we saw a lot of concern that we would start to see. There was an expectation that there would be a large number of defaults on rent, that there'd be a significant issue with voluntary agreements, that there'd be a significant situation where we'd see a lot of retail and office space lying empty if there was a situation where the lockdown didn't end quickly. It doesn't feel to me like our expectations were quite met, and I mean that in a positive way. So Paul, can you just sort of give us a flavour of where you thought things would go and whether that agreed with the wider market, and then sort of give us an idea of sort of what actually happened and where the differences may have, and why we may have had some of those differences.
Yeah, no, you're absolutely right. The way the year panned out, it proved to be much less severe than we thought it was. I think that 12 months ago actually seems a very long time ago now. But I think if you do roll the clock back, actually 2020 started with quite a lot of optimism, and that reflected a number of things. One was that the broadly fundamentals in the property sector were quite attractive, and obviously going into 2020, a lot of political uncertainty had we thought had gone away with the Brexit situation and the general election at the end of 2019. So we were quite optimistic that 2020 would be a good year, a year of recovery, bearing in mind that the previous sort of 12 to 18 months had recorded, consecutive months and quarters of capital decline. So we were quite hopeful. Obviously, the pandemic came along and changed all that, and when that did arrive, we then did become concerned, and naturally concerned, because lockdown imposed some considerable practical limitations, and so we expected that transaction volume in both investment markets and occupation markets would decline, and that's what it did. In Q2 we had a record low of transaction volumes for investments. It was about £3 billion, when typically in a quarter you expect about 13-14 billion pounds. Valuations, we were worried about valuations because our experience is when you get uncertainty, valuers get cautious, and that's a trigger for valuations to start to decline. And again, that's what we saw. But not only did we see valuations start to decline, but also the scale of uncertainty was such that valuations became unreliable, pricing became unreliable, and property funds like the LAPF were forced to suspend dealing. So that was all pretty serious stuff. So I think we were very right to have concerns, and I suppose like with the health situation, those with pre-existing conditions were more exposed to the pandemic, and it was the same in the property sector. Those with pre-existing conditions, like the severe structural change that was going on in retail sector, and the fact that retail activities, leisure, hospitality were, they were hit very severely and first as a result of lockdown. So again, we expected those trends to continue. But as you said, as the year as worked on, it wasn't as bad as we thought it would be. One point I've forgotten to mention, actually, probably the most important point, in particular for the listeners today, is the impact on rent, because quite early on it became quite clear that there was going to be a rent collection challenge because the nature of the pandemic, the impact on business, cash flows, revenues. Tenants would not have the revenue and net income to pay the rent. And that was probably the most serious threat that we faced in the year. And as I said, that was a very serious prospect for our investors that relied on the income that we generated. But I'm very pleased to say that despite some initial challenges, rent collection records were actually very good during the year, and in the end we were able to collect a large proportion of the rents. Naturally, the more difficult situations were in that retail sector, but if you're a proactive manager, you engage with your tenants, you are able to manage that situation, agree relief packages for those tenants that are in genuine distress. And the interesting feature is that, we've got to the end of the year, we've collected most of our rents, but the rents that we haven't collected are largely not from tenants that are in distress. They are actually from large, well-funded corporates that have chosen not to pay. They won't pay rather than they can't pay. And, they've taken advantage of the UK government's policy, which has restricted landlord action to take to recover arrears.
Paul, if you look back over that past 12 months and the actual experience of the virus versus the underlying trends that you mentioned at the start were sort of powerful influences on the sector, what do you think would be the balance of influence? How much was the underlying weakness in retail? How much was the problems caused to retail by the COVID outbreak?
Yeah, I think that the balance of the problems was very much in the retail sector. That was a sector that was already sick, and that sector. I talked earlier about that we were on going into this, we were on a trend of falling capital values, and that had largely up to that point been driven by falling values in the retail sector, and it was only the scale of the reductions was only relatively modest because you had support from the industrial and warehouse sectors that were providing a positive support. Otherwise, the results would have been more severe, and that's exactly how it turned out during 2020. Retail decline in retail values, driven both by yield expansion and also falling rents, very weak sentiment. That drove a huge acceleration in the decline. Retail values dropped by 17%, as noted by MSCI, and perhaps the most surprising positive aspect to this was that whilst we all knew that the fundamentals in the industrial sector were attractive and supportive, I think we actually underestimated the strength of that sector, and also the fact that industrial warehousing, in particular in the logistics sector, were a direct beneficiary of the woes of the retail sector, i.e. the switch from high street shopping, physical shopping to online, and also the fact that the pandemic, the lockdown, drove us all to shop even more online. So the boost to the industrial warehouse sector has been immense.
So when we look at something like, one of these obvious, there seems to be winners and losers. So we've got our winners in industrials and perhaps our losers, perhaps slightly unfairly in retail. And as you've pointed out, some of the bigger corporates taking advantage of the moratorium on landlord action. If we try and think about that as a sort of what was going on, and sort of, it seems to me that still retail hasn't, even though we've seen valuations fall to 17%, they haven't fallen, by 17%. They haven't fallen by 50% or 60%. It seems to me that there's still the impact seems to have been relatively still muted. Is there a reason why some of the more apocalyptic sort of predictions didn't come to pass? Is it all government support, or was it the ability of change of a lot of retailers going online or being able to do click and collect, or is there something else going on, or is it just a bit of optimism that this is going to be a temporary thing?
Yeah, I think it's a combination of all of those things. I think of course government intervention has supported the economy. It's supported business and retail tenants who many of them are very much they're on their knees, and they are they're on life support, many of these tenants. So I think that the data is not truly reflecting the scale of the problem. And you've only got to look at vacancy rates in the retail sector. It's the vacancy in retail property is about 6%. Which is well below the average for all property. That doesn't seem to make sense. And when you look at when you look at what's going on in terms of leasing and occupation, it then explains what's going on, and we know this because obviously we have direct involvement in this with the management of some of our retail tenants. That many of those retail tenants, they're only in occupation because they have or rather the units are not vacant because the tenants are still in occupation because they're getting this support. It's not just government support, they're getting support from their landlords in terms of reduced rents, the relief packages that push back payments over a number of years, but also many of them they're in insolvency procedures, they're in administration, they're in CVAs, and what that does is in many cases it just prolongs the agony. And our experience is that these CVAs get forced on us. We have to accept the terms. We're not going to kick the tenants out because all you're doing is jumping out of the frying pan into the flames if you get rid of your tenant. It's just putting, as I said, it's putting off the day.
I mean, we seem to have moved quite nicely actually from sort of where we thought we'd be to where we actually are, which I think is quite useful. And some of the points you're making are really, really useful in the sense of that actually a lot of these companies are, shall we say, as you put it, on life support. That it's almost artificial, the fact that we've got a low vacancy rate. I mean, one thing I was wondering if we could draw a little a thread from is there a lot of regional variation within this? Because I sort of get the feeling that perhaps some of the company, it used to be that you wanted everything in London almost because London was a big commuter place, lots and lots of money, lots of people there. But now now people are working from home more and shopping locally and doing things more locally. Is there a regional variation which is almost flipped round, or is that a bit of a too easy a just so story?
Yeah, I'm not sure that there is a regional variation in that way. I think the problem is not so much with the locations; it's with the tenants. And it's the same tenant. It's the same tenants that are in Newcastle, Birmingham, and Central London. There's not a lot of the reality is that there's not a lot of diversity on the high street. They and that's one of the problems with the high street. They've become very stale environments, over the last sort of 30 or 40 years. Retailing has overtaken and dominated town centre activity, and as I say, it's increasingly focused on a relatively small group of national retailers. And obviously with the pandemic, London, any major city centre is suffering really badly, and they're suffering along with the more regional centres, the market towns. They're all suffering. So I don't think, I'm not seeing any data on this. Maybe there is something in the data, but my perception is that there is not a sort of a trend of that nature, in particular with this problem.
So looking at we had a very clear idea of where we perhaps expected the fund to be, and things are, and the wider commercial property rate. With that in mind, is there, where is the fund right now? How is the performance as it is right now, and where do we expect things to I don't know whose dog that is, but I'm glad for once it's not mine, because usually it's
not my dog.
Barking, but it's not. Yeah. So so thinking about where the fund is now, how is it sort of obviously we have seen a reduction in valuations. How has that impacted the fund, and obviously we've seen strong income performance, but where is the income in the fund at the moment? Over the as we sit here, what just to think of a snapshot.
Yeah, I think if you have a look at the results on a sort of quarter by quarter basis, in line with the market generally, it looks volatile, because the worst of the conditions and the results were in Q1 and Q2, but very quickly we moved onto the road of recovery, and it's been a really good year for the fund on a number of fronts. And because it's been a good year on a number of fronts, it's driven performance that far exceeded the what we feared at earlier in the year. I think the driving force really in that success is really in the asset management that we've achieved. Again, we all feared that lockdown would the impracticalities of lockdown would interfere with our abilities to manage the assets. But it's been an excellent year in terms of asset management progress, and on top of that, strategically, we've been well placed too. We've had some great success with individual assets in terms of letting those properties, achieving significant uplifts in rental income, and the fact that you've let the property and you've moved the rental value on has a significant impact on the valuation of those assets. So you get a strong driver of performance. But if you add to that, so that's what's going on in terms of the bottom up approach. But then if you look at the top down strategic approach, you see that the fund, its exposure to shops is about 2%. It's incredibly low, and it's been low for some time. And at the same time, we have almost 40%. I think it's about 38%. In industrial warehouse property, again a weighting which is higher, comfortably higher than the benchmark, and that combination of features, because the dispersion of returns across those sectors is it's almost at an all-time high. As I said earlier, retail values dropped 17%. Industrial values increased by 4.6%. The total return from industrials was nearly double digit. So if you've got that weighting, it has a big impact on the performance of the portfolio. And then if you throw into that mix the asset management successes that I'm talking about, it's not surprising that we end up having a good year. Now, what does a good year look like? Because we're active managers, it meant that the rent collection challenges were nowhere near as a problem in the end as we thought they were. The income distributions that we've made this year were, I think they're about 97% of the forecasts that we had pre-pandemic, which is excellent in the circumstances. in terms of valuation growth, we moved back into positive territory in Q3, and we had an even stronger positive movement in capital values in Q4. Now, by the end of Q4, the sector, as recorded by MSCI Capital Index, was still negative. So there's a clear feature there of success, and at the end of the day, that comes through in our results. Our total return for the year was just minus 0.5. As I say, bearing in mind that the forecasts, the sector forecasts at the start of the year were for double-digit negative capital growth. I think that is that's a very good outcome in the circumstances. And as I said earlier, the biggest relief for our unit holders is that we've almost replicated the distribution from the previous year and very close to our forecasts.
Which is surprising considering it's such a tough year. I mean, even though when you explain it very clearly of building the building blocks of the fund and how why the fund has performed the way it has, it's still surprising when you say that well, even considering all of that, you've still done, as you say, 97% of the expected distributions. It's still not what you would expect when you turning on the news. I mean, to move on and thinking about switching on the news, I'm sure you've seen this morning that that Nationwide, the Building Society, has told a huge number of its staff that they can just work from home forever now, that they are moving away from the idea of having everybody in the office. And all the anecdotal data, all of the news stories is about the death of the office. I'm sat in my house. I can see that I think you and John both are as well. I mean, we're all making this assumption that the offices are doomed almost, and that's going to have a big impact on commercial property investors. When you look, you just need to walk around the centre of any big town or city, you'll see offices there. I mean, do you sort of share that received wisdom that the offices are done, or are we lacking a bit of information? And just more generally, we're making a lot of assumptions, but equally, there's still a lot of uncertainty within the commercial property market at the moment. How do you expect to position the fund over the next 12 to 18 months to take all of that into account? And are there any areas you think, well, actually, the data is telling? I mean, it seems that you've been pretty clear that the data is telling us retail is under a lot of pressure. But it'll be interesting just to know how you're going to, if you agree that the offices are going to be under pressure in the same way retail is, and also how you're going to position the fund just more generally.
Yeah, I think this is this issue surrounding offices is incredibly interesting, but I think we have to be very careful to not overreact to this. At the end of the day, the debate that we're currently having about offices is only a debate. There is no firm evidence of structural change in the office sector. It's something we're talking about, and of course the experience with the pandemic has quite fairly raised those issues. It's we've all been on this working from home experiment. The technology is being tested to see if that works, and we all know that when it works well, but it doesn't always work. I'm sure most of us are pretty fed up having Zoom calls and things like that. So whilst I wouldn't say that this isn't important to consider, I think that we don't know enough yet to know how this is going to play out in the future, and therefore we shouldn't overreact yet because we don't have the data to confirm. Now, what we do know, I think what is real is that those concerns exist, and you can see that concern feeding into the marketplace in terms of weakening investor sentiment towards the office sector, to reflect what is at the moment added risk for the office sector. It's not confirmed damage. It's increased risk. And so what happens when you have that situation is that investor enthusiasm for the sector starts to wane, yields start to expand, and that's what we have seen as 2020 has progressed. Against trend, office values, the decline in office values increased in Q4. We lost about 2% in the value of offices in Q4, which was higher than the loss in Q3. So, it's quite clear that those concerns exist, and we are seeing that being played out in the marketplace. But it doesn't mean that the office is doomed. There's no evidence yet of falling rents. You mentioned that we're sitting here on a Zoom call now, but that's because we can't work in the office. We're forced. For the last 12 months, we've been forced to largely work from home, and it'll be interesting to see what happens when that lockdown is lifted and we all start to filter back. Businesses reoccupy their premises, and as employees, we all start to filter back. And even if we do have changing working practices, that doesn't necessarily mean that the office requirements will fall. What will change is the way we use offices, not necessarily individual corporates having smaller accommodation. They will just use their accommodation differently. They will have fewer desks. They will have more breakout space, more collaborative type space. Hot desking areas for those that are in the office some days, out of the office other days. So I don't think it's a given that requirements will reduce.
Great. Well, we've slightly overrun, which I think is okay. We've everybody seems to be most people are still on the call because it's been such an interesting session. I will sort of bring it to a close there, unless any of our listeners do have any questions. We do have a chat box to throw in any questions you may have. So I'll just give our colleagues and our clients a few seconds just to furiously type out any questions they may have. Whilst we're doing that, though, I'll just remind our listeners that we do have as we do every week, we'll have another session this time on Thursday. Next week, we're talking about the Prudential Cone consultation. You'll have remembered, hopefully some of you will remember the interesting conversation that my colleagues David and Mark had about 6 weeks ago, discussing the consultation and our view on our very early views on it. Next week, we will have put together our full and informed and gospel house opinion, so you'll be able to hear us talk about that and obviously decide whether you agree with it or disagree with it before you respond to the consultation yourselves. We haven't had any questions, so I will bring us to a close, and all that leaves me to do is thank Paul and John very much for joining us. So thank you very, very much, guys, and thank everybody for listening. So thank you very much, and hopefully I'll speak to you all again soon. Thank you very much.
Thank you very much. Bye-bye.
Thank you all.